Hi, I'm Max Keiser. This is the Keiser Report. Well, we're seeing what happens when the world deflates. We're seeing some odd behavior. For people out there who say, what about healthcare? What about student costs? Those prices are going up. That's inflation. Not against gold. That's the key. Everything's deflating against gold over the past 10 years, particularly Warren Buffett's stock. All right, let's hear more. Stacey Herbert.
Max, it seems everybody in the world is seeking salvation, economic and financial salvation. First, of course, you mentioned gold, so I'll mention this headline in the news. Italian police seize gold worth 2 million euros at Swiss border. Italian tax police have seized 50 kilos, which is 110 pounds, of gold from an Italian businessman at the Swiss border.
Well, the first thing I thought about when you said this story, of course, was the scene in French Connection, where they find the heroin packed away in the runner board of that car imported over via Marseille from the French guy to New York, where Popeye Doyle, played brilliantly by Gene Hackman, eventually captures him. But this is not about heroin. This is about gold. And of course, gold is getting across borders now as people try to figure out what to do in this global deflationary nightmare. They want to hold on to something of value that maintains its purchasing power. So you see the evidence of this now in behavior, not only in the markets, but in the behavior of people.
Well, exactly. Two things in the article are mentioned. First of all, that the Italians are believed to have billions of euros in undeclared wealth stashed in Switzerland, funds that Italy is now trying to have the Swiss authorities tax retroactively. You mentioned the deflationary collapse, and this is part of that deflationary collapse, is everybody is scrambling to find any sort of assets anywhere in the world, whether it's JP Morgan looking to make good on their, all the black holes in their balance sheet, or it's the governments looking to fill the black holes in their balance sheets.
Right, and of course, Italy, it's got 2,400 tons of gold, the government does, on their balance sheet, and who's been snooping around looking at that trove of gold? Oh, Germany. Remember, Germany is saying, oh, all of you European countries that want our cheap loans to stay in the euro, happy to do so, just give us all your gold. So once again, gold is, of course, the only salvation, as you put it, in a world that's collapsing from this deflationary nightmare. It would be collapsing a lot quicker, Stacey. However, the central banks are pumping cash into the system, which is basically just like the branches preventing the global economy corpse from hitting the ground faster. But it is definitely heading lower.
But this border, this Swiss border, is really becoming the ground zero for this war between the bond vigilantes and the gold vigilantes now. We see some people crossing the border with trillions in bonds. Now the gold vigilantes are making their move.
Right. Just a year ago or so, the story was trillions in bonds being transported over the same border. That should tell you, in just in space of 1 year, the preference from nonsensical paper to gold has changed. People realize that you just can't put up nonsensical paper as collateral anymore, even if you're a central bank in Switzerland or the ECB. They're now looking at the real stuff. And so the criminal behavior out there in the world is changing to reflect the preference now for actual stuff.
Yes, and everybody's seeking salvation, whether it's criminal behavior or deranged behavior. Austerity doesn't pay as debt markets ignore rating cuts. U.S. borrowing costs plunged to record low after S&P rating cut, as you can see from this chart in the article. And Britain's bond yields also plunged following their rating cut. But however, it's not just Britain and the U.S. After Standard & Poor's stripped France and the U.S. of AAA ratings, interest rates paid by countries to finance their deficits dropped rather than rose. For investors and policymakers predicting the consequences of a ratings change by S&P or Moody's, the dominant issuers of debt scores may be little different from flipping a coin.
Well, this is concrete evidence that these markets are not free to trade per market activities, per true supply and demand curves. These markets are being held captive by algorithmic trading, by quantitative easing, by central planners who are using financial repression, as it's called, to keep interest rates artificially low. And it's great, except that the price of gold and silver is saying that, most people don't believe in your salvation in paper. The paper salvation is not really going to work. And this is why people are smuggling the hard assets around the world, trying to escape this theory that paper will somehow trump gold.
So according to Bloomberg's analysis of 314 upgrades, downgrades, and outlook changes over the past 38 years, the rates moved in the opposite direction 47% of the time, as one would expect. So I think this is part of your price propaganda story that in response to somebody daring to downgrade the US or daring to downgrade the UK, of course, the central banks, we don't know who the buyers are who are buying it, sometimes negative yields in the case of Germany or Switzerland or some Scandinavian countries. Who's buying at negative yields? Is it the part of the financial war that we talk about?
Well, a lot of it's just computers buying. They're programmed to buy from other computers. Again, 86% of the trades on the New York Stock Exchange are computers trading with other computers. And we now know from a Forbes article recently that a lot of the computers are reading articles in the financial press that were written by other computers. So this is called computer-aided narrative technology that Forbes uses, and they put it out there into the general population. Computers read a computer-generated story, and then they base trades based on what the computer, in many cases, the same computer. So this is a lot of times just computers circling around themselves in the motion that you could liken to circling around a drain as the economy plummets into the sewer.
Next headline, Max. David Cameron fears near perpetual stagnation in Eurozone. So the Prime Minister of Britain says that Britain must look to emerging economies for economic salvation.
Yes, well, once again, the Eurozone, I like the way he conveniently omits Britain from the Eurozone. When it's on the way up in a bull market, of course, it's raw Eurozone. But during the hard times, it's, oh, wait a minute, we're an island. We've got nothing to do with the continent. Leave us alone. We've got our own currency. We've got our own central bank. It's nothing to do with you guys. We don't even know you guys. What? We never heard of you guys. So typical duplicity from a Tory leader. What else is new? And his island nation is sinking into the muck. The austerity measures are a bust. George Osborne is trying to walk back as aggressively as he can without losing his entire support. The coalition is a shambles, and that won't last much longer.
Yes, but Max, I believe hedge funds and Goldman Sachs have already been in the so-called emerging economies for quite a few years now. We've been talking about it. The BRIC nations even was coined by Jim O'Neill from Goldman Sachs. So now Cameron comes up with this brilliant idea where people have already been for years and years and years. And in fact, those guys are kind of getting out of China, saying, get out of China, get out of Brazil. The real is like at all-time highs.
Yeah, the phrase for this is top tick. So top tick Davy. So he's coming in at the top tick. You know, it would be like buying Facebook on the IPO, for example. You top ticking this stock before it plummets, or buying Groupon or Zynga at the opening. This is the top tick. You know, after that, it's a 20, 30, 50% drop. So yeah, David Cameron is stumbling into these markets, and when the horse is bolted, you know, there's no more bones, no more meat on the bones of the BRIC economies, Dave Cameron. You're not going to salvation yourself using, you know, hey, didn't they already throw Britain out of these countries before? You know, they don't have a welcome sign. They don't want you back. You've already been thrown out, Dave. Stay out. Go away. India doesn't want you. Remember? They got rid of you.
Well, let's go look at one of those emerging economies, Max, and that's South Korea. Suicides, arrests show trouble at Korean savings banks. So far, regulators have closed Korea's 20 weakest banks, and prosecutors have uncovered illicit lending and lax oversight, leading to indictments of nearly 200 people and at least 2 jail sentences. 4 bank executives have committed suicide, according to police, and more than 88,000 depositors and bondholders, many of them retirees, saw 1 trillion won, which is $857 million of their savings in excess of insured levels, vanish.
Right. So in Asia, there seems to be a real deterrence. We see this in China, where they penalize bankers who've committed fraud with the ultimate harshest of penalties. Now, some of these bankers in South Korea, from what you're saying, they've committed suicide. So there is a real notion of shame in these countries when they steal money. That's something you don't see in the UK. That's something you don't see in America. There's no idea of shame. The stealing is not a shameful act in America or the UK at this time. As a matter of fact, it's celebrated as a reason to hold these people up and lionize them. When Jamie Dimon goes in front of Congress, he storms in like a conquering hero because he's one of the biggest thieves of them all. There's no shame in Jamie Dimon's dictionary. So this is a very interesting culture clash between the East and West.
One woman they talked to, Max, Ji Mi Young, who lost 40 million won, or about 35,000 US dollars in Korea Savings Bank. She recalls getting a text message in September 2010 from Korea Savings pitching 5-year notes yielding 8% annually. It was easy, the bank promised. She invested her mother's savings 4 times as much as her own in bonds that aren't protected by deposit insurance. She said, quote, How can I tell my 80-year-old mother I've lost the funds she lives on? I was deluded by a couple of percentage points of interest rate. Now I can see it was only a trap.
Well, this is a trap that we've seen in the mortgage market. Banks offering mortgages to customers that they themselves didn't hold on their own books, the liar loans. This caused a huge multi-hundred-billion-dollar catastrophe in America. That was the banks doing. Here in Asia, banks offering CDs that they can't possibly pay off. We saw this during the savings and loan crisis. We see this time and time again. They're talking about a global banking institution or lending facility to bail out these banks. How about if bankers want to operate globally with no law whatsoever, there should be some attempt to either A, prevent that from happening and have no too big to fail banks, that is to say no banks can have more than 1 or 2% of any given market in any given country, or B, they're going to be subject to some real harsh deterrents and penalties. The banking industry in America under FDR's regulations functioned brilliantly for 50 or 60 years before all those were repealed away under successive administrations in Washington under the direction of bankers who were interested in getting their hands on that money in an illegal way. The same thing that we saw in the 20s leading up to the crash. Now that they've been given the ability to do the exact same thing all over again, we're having another crash.
Well, I want to tell this woman, Ji-Mi Young, to beware any calls from David Cameron because he's going looking for her. They're looking for high yields, growth economies. She says, I wish it were a bad dream about this text message she received that resulted in her losing her mother's life savings. I always wondered what kind of stupid people put precious money into messy banks. Now I am one of them. I think, Max, you can look at the entire global financial system. You can look at America, you can look at Ireland, you can look at Iceland, you can look at France, Germany, Greece, the UK, South Korea, China, Japan, Brazil. You can look at everybody and we could all say the same thing. I wish this were all a bad dream. I wish we hadn't been so stupid and picked up the phone when Jamie Dimon called, when Lloyd Blankfein called, when David Cameron called, when Tony Blair called. Well, actually, when Tony Blair calls, you end up dead.
Well, Milton Friedman famously said he'd never get nothing like a free lunch. And yet, that concept of getting a free lunch is the entire concept that drives Wall Street in the City of London now for 35 years, getting something for nothing. Write debts you never pay off except with more debt. Now suddenly, that's all coming to haunt them. Milton Friedman, of course, laid the groundwork for this abomination called neoliberal banking, and now we're seeing the result of it. So he was right in one way. However, in the long run, he proved to be a bit of a charlatan, as are all of the other neoliberal architects that brought us this current catastrophe. Stacey Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away. Much more coming your way. Stay right there. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Rick Ackerman of Rick's Picks newsletter. Rick, welcome to the Keiser Report.
Hey, Max, how you doing?
Fantastic. Rick Ackerman, tell us what happened to all the hyperinflationists.
I think they've been pretty quiet lately, Max. We have nothing but a deflationary juggernaut unfolding in Europe. Austerity may have been voted thumbs down, but you don't see any infusions of new credit making their way into the system. It seems like everything that's happening in Europe right now has a deflationary outcome.
Right. The ravages of the credit peak of 2007 continue to wreak all kinds of damage around the world. And no matter what the central banks try to do to stop it, the deflationary pressures continue to mount. What do you tell people when they say, well, look at the price of medical costs and look at the price of student loans? These are rising in price. How does that factor into a square against this deflationary trend?
Well, I call that lettuce bin inflation, Max, and compared to the larger deflationary picture, which is an asset deflation, the grocery store inflation is relatively tame. Even that's going to hit a wall because the money that you spend on groceries has to come from something else if the price of groceries goes up because real incomes are stagnant. So it's really sort of a closed loop. And if the price of one thing goes up, it means that less is available for something else. But also, I think that the three intractable engines of inflation are slowing down. One of them, of course, is government spending. And at the state and local level, it's actually crashed and burned. That hasn't happened at the federal level, of course, because the federal government can print whatever it needs. But Two other engines of inflation, healthcare and education, have sort of hit a wall. On the college end of things, for a number of years, the colleges basically collected their fees from parents who were putting their homes in hock. Second mortgages were paying a lot of tuitions. But of course, that route is not available. And I think that even though tuitions continue to go up, they may have reached that point where the coyote has run off the cliff and just hasn't looked down yet.
Let's talk about the euro for a second. The euro has become a very volatile currency with huge swings in both directions. What are your charts are saying? Despite the political and the debt crisis, the euro, where's it ultimately heading?
A very interesting question, Max. From a purely technical standpoint, I'm looking at $1.08, and I feel pretty confident about that. It goes against the common wisdom that the euro is headed to at least par with the dollar or lower. And because it doesn't seem to be going that low to me, the question is why? As far as I can see, or as far as I can reason, the countries that are solvent still using the euro are stuck with it. If, for instance, Germany or Finland or the Netherlands were to attempt to go back to their original sovereign currencies, the whole world would converge on them. They would basically say, geez, I'd love to have German bonds or German this or that, because the Germans are very prudent stewards of their money. So that's the last thing in the world that Germany wants, is to be the hard currency of the world. So they're all, I guess, going to be keepers of the flame. They'll retain the euro regardless of which countries, Greece, Italy, or Spain, perhaps, exit the currency union.
Okay, so let's talk about Germany some more. They recently floated the idea of a European redemption fund whereby nations would have to put up gold as collateral for any national debts over the Maastricht Treaty limit. Your thoughts?
Well, I don't think any of the countries in debt are going to easily give up what you would call real money. No one has any skin in the game except for Germany, and that's why Germany is insisting on hard currency and hard terms. But as far as the debtors, if they ain't got, they ain't got.
Well, I mean, gold has been talked about by us in the study of which way inflation or deflation will impact the price of gold. It seems as though even though you've got deflation, it's deflation in everything against gold, correct?
Yes, but you need to understand that the whole world really doesn't prefer a hard money standard. You know, even the Chinese use a debt-based money, and it's really the payment method of choice. If countries were forced to pay for instance, oil with something other than worthless dollars, there'd be a lot less oil sold. So it's an arrangement of convenience that the oil-producing nations accept fiat currency, which they convert into essentially the next best thing, whether it be euros or dollars or gold or silver.
Right. But these countries are now aggressively buying gold. They're doing swaps outside of the dollar reserve. They're positioning themselves for a return of gold. Germany now wants gold. So clearly the writing is on the wall that once again, as we've seen historically, gold ends up being the reserve currency. Now, let's talk about the U.S. Treasury paper market for a second. This is a recurring theme. We've touched on it before. The question always is, have the U.S. Treasury bonds finally tapped out? And is the bull market that's been going on for 30 years and U.S. Treasury bonds finally run its course? It just keeps on going and going and going. Your thoughts? What do the charts say? What are the fundamentals? This is really the biggest question of all, I would think.
Yeah, it really is, because as the dollar goes and as dollar instruments go, so goes the world's financial system. From a technical standpoint, Max, I've been looking at a run-up perhaps to about 170 basis the T-bond futures, and that would mean that there's some room for yields on the 30-year to come down a bit. They're somewhere around 2 5/8, 2 3/4 now. But from a technical point of view, with the T-bond futures up around 170, it puts yields down around, I'm guessing, 2.1% or so. So there's probably some room to move for the bonds, but I think that relative to the 30-year run-up, the 30-year bull market in bonds, they're getting close to the limit on the low end for yields.
Right now, here's a question about the analysis, whether it's technical or fundamental. I mean, the U.S. government itself is buying, by last estimate, 61% of the U.S. Treasury paper that it floats. So it's just recycling itself. This latest auction, they bought billions of dollars worth of bonds, and then they sold billions of dollars worth of bonds 6 hours later. So it's become a huge laundromat, a huge Ponzi scheme, I'd say. So does that impact the technical analysis or the fundamental analysis? It's become a really a joke. So I mean, or does the technical analysis, is that the beauty of it? It sees through all of the underlying shenanigans.
Well, I think that's true. That sometimes it's a little too difficult to parse all the logical pieces of why bonds go higher, or why the dollar is weak or strong. And that's why I ultimately depend on the charts. But sometimes, as is the case for this $1.08 projection on the euro, I start with the projection and try to back out the logic. But you're right, it is a Ponzi scheme. I've heard higher numbers than 60% as far as how much of the Treasury paper, new Treasury debt, the Fed is buying. But it's really a shell game. If you say that the Fed is not doing QE3, that it's not monetizing, it's effectively doing that by making credit almost free to the banks, so that they have to park it in treasuries. And of course, in Europe, the swap arrangement with the U.S. Federal Reserve makes it possible for Italy or Europe to have its own monetization, but to have it in a currency other than the euro. So it really is it's worse than a Ponzi game. It's a fraud that I should think anyone would be able to see through at this point.
Right. Well, to be honest, the total aggregate amount of U.S. purchase of its own paper exceeds 100%. If you understand the collusion between itself and Wall Street, this is why the total indebtedness keeps skyrocketing to levels that have historically never, ever been achieved. And this is, as you point out, worse than a Ponzi scheme. It's financial suicide vis-a-vis death by paper creation. But this is something that America seems comfortable with at the moment. Now, speaking of federally backed paper, you've written recently about the student loan market. Is this the next subprime disaster, the next part of the global J.P. Morgan disaster that will require more austerity, more printing, more of the same?
Well, it's $1 trillion boondoggle at this point. And in the bigger scheme of things, $1 trillion is, I'm going to say, not much. It certainly is a lot of money, but at the margin, it is one aspect of the big picture that could probably topple things, but I don't think so. I think that the student loan program is simply going to wind up as a scandal when it turns out that very few of the loans are repaid. We already know that the borrowers are coming out of school ill-prepared to make the kind of money that will allow them to put aside a little bit. Not that any of us can put aside anything these days, but I think the average indebtedness coming out of college is, I've heard $36,000. That's a lot of money for a newly minted humanities grad, someone with a BA in literature, to pay back. And so I think that the $1 trillion might as well be written off at this point.
Right, and this might be a good time to drill down and look at this relationship between inflation and deflation and prices. On the student loan market, the reason the cost of student education is going up is not because of an increase in demand. It's because of an increase in credit, which is ultimately got to be paid for. And since they don't have the ability to pay for that credit, it results in deflation. So this is a masking deflation, where deflation gets masked in the ruse of a fake price signal. That is to say, a fake price for student educations, which is driven entirely through financial manipulation and has nothing to do with the rule of supply and demand. Would you agree?
That's absolutely correct. You know, the student loan bubble is really the same as the housing bubble. The demand is artificially stimulated simply by the availability of easy money. And in this case, the student loans are much easier money even than housing money was during the first go round prior to the 2007 collapse. You know, Obama has more or less said, hey, this is with a wink. Don't worry, you'll really never have to pay it back. And even if you go to the letter of the law, the payback terms are so simple, they're so easy that a student can easily see borrowing without the expectation of paying back.
All right, Rick Ackerman, we're out of time. Thanks so much for being on the Keiser Report.
Thank you, Max and Stacy.
All right, that's going to do it for this edition of the Keiser Report with me, Max Keiser and Stacy Herbert. I want to thank my guest, Rick Ackerman of Rick's Picks. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.